Today I have the pleasure of having an old friend of mine, Jason Roney, to come on and talk to us. Jason and I worked together in like 2000 when I was on a prop desk at a Gelber Group, and um, there were a bunch of us on that desk, and I would argue that Jason was the best trader on there, and he still trades to this day. And a lot of times when we have conversations and people ask me about, well, what do I think about day trading and all this, and my answer is always, look. I can only base it on this. I've known hundreds of people have heard me say this. I've known hundreds of people that have tried to be day traders, and I can think of maybe two that have lasted. And when I say that, Jason is the person that I'm thinking of. I'm one of the two anyway. And I don't even know who the other one is, but he's one of the two. So he was successful at that type of stuff. Not that he's necessarily a classic day trader, I don't think. We're going to find out, but he's going to tell us. So anyway, Jason, welcome, and thanks for coming on.
Good to be here, man. This is nice. There were some kids in the office that mentioned your report, and it's good to have your name come up. So good to touch base with you again.
Cool. Um, So why don't you just give us a quick sort of background, how you got into this game
Yep.
and how it went and how you ended up where you are now.
Yeah. So like you said, we started, at Gelber Group back in the early. That was my first trading experience. I mean, I graduated in accounting, but that lasted 1 year and decided I wanted to get into the markets. So, Gelber was a short-term trading shop. Learned a lot of short-term trading tricks, and things were a lot easier back then. But the game changer was I got introduced to what I'd call my mentor, Bill McKenna, and he had traded for Michael Steinhardt, and his affiliation with Brian is there was a Gelber fund back in the 80s. So Brian introduced me to Bill, and kind of learned the macro thinking. Basically, a guy that traded for Michael Steinhardt. Today, he runs a big book for Tudor. He spent some time with SAC. So I spent having 20 years under his tutelage, so to speak, and kind of learned to think like a macro trader. But at the end of the day, I'd always grown up trading short term through Gelber. So more or less, I like to think of myself as a micro macro trader, short term macro, if that's a thing.
Looking at macro themes, but getting out in 45 minutes.
Yes. Well, you said day trade. I mean, the reality is nowadays there aren't a lot of 45-minute trades, but yeah, I mean, I love a quick one, but I'd say the average time frame is 1.5 to 3.5 days, so a couple days.
That's now. So you've kind of sort of spread it out a little bit.
Yes, for sure. And added cash equity. So, I moved to Austin, Texas. I mean, I had after Gelber, and the business became a lot more quantitative. I launched my own CTA. That was in 2014. Had that for about 4 years. That grew pretty big, but kind of realized the market cap, the notional value that I was able to trade was smaller. I mean, I can't spend a couple hundred gold for a small amount on a number. So kind of move that back down to a smaller base of just the core investors and alongside my own money, and ran that essentially on my own for several years. It kind of got a little boring in Chicago, and then like 3 years ago, I got mutually introduced to a discretionary trader in Austin, Texas, Andy Kirshner Equities. It's a pretty good size shop, but they focus mostly on cash equities, and kind of align myself with them, move the family down to Austin where the weather's much better, and basically still operate the same futures business, but now you can also participate in cash equities, and kind of have learned a few short-term trading tricks from those guys. And as the markets have evolved, because it's always evolving, there's sometimes a more efficient way to express a shorter-term idea or momentum in cash equities. So still the same core strategies probably that I've been doing forever, since I started in 1997, and the same process that I go through every single day, but now also introduce some cash equities.
Cool. So can you tell us a little bit about that? Hey, the core
Yeah,
process and see how
yeah,
it's you're putting into new things and see
yep,
what you do go through every day and all that.
yeah. So the whole thing. I mean, every day, and I think process is key for just about anything, no matter what strategy you're doing. But every morning starts out with just sort of a rehash of what are the macro themes, what positions, what direction do I want to be in various assets. Have a core theme based on recent economic trends, recent momentum, and I break down the future space into various asset classes. So there's currencies, but within it there's developed market currencies, there's commodity currencies within fixed income, short and long end, and then there's German, UK, and the US. Within equities, it's similar. You got the major countries. Metals, you have industrial metals, precious metals, and then there's energies. And so I basically have more or less, it's within those asset classes, you kind of think of where's the opportunity zone, right? I mean, that the advantage is I can go to where the opportunity is. So, and if you think about, I think about the opportunity in a four grid matrix. There's low volatility, high volatility, and then there's low trend and high trend. So, if you can kind of just assign a regime, if you will, to each of those asset classes that I mentioned and sub asset classes, there's less opportunity in low vol, low trend, and I'd rather participate in high vol, either high vol low trend or high vol high trend. And so it kind of narrows it into, okay, these are the spaces that there's the most opportunity. And so the difference between me and a normal macro guy, right? The macro guys, they have a view and they got it on, and by default, when it goes further against them, they probably like it more, right? So that the
Right.
difference with me is that I'm only interested in those sub asset classes where the opportunity set is higher based on the regime, and I have a preconceived directional bias. So I start with a bias, and then from there, it's a lot of just shorter term patterns that get you in. And so what are those patterns? I mean, I am entirely more or less like a three trick pony. I mean, there's expansion contraction metrics. So I have a spreadsheet of ratios that reference the closing ranges of things versus the ranges that they're trading. If something's trading in a 100 tick range and then it closes within 5 ticks for 3 days in a row, well, there's one of two things that's going to happen, right? The volatility is either going to contract, or the market, that product is going to move directionally closer to what its recent vol is, and since we trade direction, both, that means I've got opportunity there. So it really drills down to, first, what asset class has opportunity based on the regime with vol and volatility and trend? Which products within those do I have a bias to be long or short? And then which of those have triggered basically the ratios that I'm looking for for a more expansionary or trend move? And then it's essentially momentum and a breakout and momentum pullback type strategy. That's it. We can dig
So
into
when you
more,
say
but
that you
that's
have
the
a
core.
bias of being long or short something,
Yep.
you have a bias just because of how you're feeling about what the asset should do, or like you're biased, you want to be long crude because blah blah blah, or what
Yep.
develops that bias?
So the beauty of the 2 to 5 day time frame, right? There's a lot of data coming out around the world. There's a cycle within the month that occurs with the first of the month data, the middle of the month CPI. There's the earnings every quarter, and so yeah, it's essentially what on a very high level. There's no reason for me on a 2 to 5 day time frame to dig into the nuts and bolts of the Australian economy or the UK economy, but to have some frame of reference to where the data is going or where the earnings trends are moving towards. Essentially, then that means I'm not chasing my tail on a 3 day move down where the fundamentals are extraordinarily strong for whatever that product may be.
So you have this bias for whatever reason. You're not
Yep,
trading it until the market sort of confirms what you're believing. Is that right? I mean, in
correct.
other words,
And that's
let's say, go ahead.
Yeah, and that's basically the key, I think. So, and the difference between me and a macro guy, just because I like something, it doesn't mean I have it on. I'm going to need that risk reward pattern to get me in. The where the I'm not very good at runaway moves because by default it just gets too extended. If I was in it early, I'll keep a quarter and I'll let that go for the ride. But but the total runaway, no matter how strong the fundamentals are, I'm not chasing it. I'm looking for everything's about risk reward and asymmetry of the move. So and sometimes when I'm most wrong, then that I don't know that I'm bearish bonds or something. If I'm most wrong, I won't lose any money because I didn't even get in. I just didn't have you never got that type of breakout pattern or a momentum like pullback setup. And I keep a scoreboard up of the products I trade, but also have another like 300 or 400 securities in there. And essentially, I call it the scoreboard, but you take the net change of something over 1, 3, and 5 days and divide it by its volatility just to normalize everything, right, in the entire world. And I have that up in the court in one of my screens every day. And so, by default, what's the strongest market in the world or the weakest market in the world? I mean, just because Walmart's up 50 cents or the 2 years are up, uh, you know, 10 ticks versus the bond only up 5, that's a big difference. So I very much pay attention to the scoreboard. If it's a market that I didn't have a setup, but I wanted to be long it and it shows up on the scoreboard, I'll just, if I wanted to buy it, be long it, and it's the strongest market on the board, I'm just buying some because it's early. Does that make sense?
Somewhat, but we're going to dig even deeper into it, hopefully. But already the themes that we hear are similar to what every good trader, I believe, says, right? I may believe this, it doesn't mean I'm doing anything. right? Until the
Yes.
market's proving it right, Um, to me, that's the most important thing.
That, and
As always.
then, you buy strong things and you sell weak things. It doesn't mean you chase, the strongest thing for 10 days, but yeah, you trade what's in front of you, not what you don't have to be right. You have to make money in this business. And so, in order to be right, I mean, uh, in order to be right and make money, I have to have a setup that goes that direction. It has to have some good risk reward. You have to be able to have vision to make at least, with a high probability 1 to 1 to maybe take a piece off, but ideally there's 2 to 1 or more, and that's how you increase your odds greatly.
So are you, let's say, whatever, you think crude oil is going to go up for whatever freaking
Yep,
reason, right? You're bullish crude oil. The crude oil, and tell me where I'm getting this wrong, but the crude oil volatility has been contracting
yep,
and you're watching it. And then all of a sudden it breaks to the upside. The volatility expands, it breaks to the upside. That's kind of where you're looking to get in.
100%, 100%. So I mean, for example, we closed the day Friday. Gold has triple in our 7 days. I'm a Toby Crable kind of somewhat of a student, but the narrowest range in 7 days. There's three of those in a row that the range is contracted. So, if I had a bias to be long gold, or whichever, and I saw some upside momentum early Monday, I mean, I'm just buying it because I'm looking to get in above or below the prior day's high. A lot of guys make the mistake of trade momentum when you're inside the prior days range or 2 days range. I mean, that's just about, there's a bunch of noise in there. So it sometimes can be really simple. So back to your crude, yes, it's consolidated and I like it, and I'm just looking for a spot. Maybe there's some news that'd be even better, or it shows it takes out the 1 to 2, 3 day highs and it shows up on the scoreboard as one of the strongest markets. I'm just buying it. No, and back to why is the scoreboard necessary? Sometimes you have to always trade what's moving, not what's being moved. And so, when cross asset correlation picks up, what can happen is everything will go, right. And so if relative to ATR, this booze are up 2x and the bonds are, in a QE world up 2x and gold up 2x, but crude looks great on a chart. It's breaking out, but it's only up 1x. It's not really, it may not be what's moving. It may just be what's being moved. So I think I try to remind myself that a lot. Is this what's really driving? Is this really the driver? And it's the direction I want, then you just have to go get it. And
I
then,
love that. So, like in that case, you're buying the strong one, not the one that's just maybe going up because all risk assets are going up today. Okay, I want to
yep,
be long this shit. This one is going up a lot. This one is going up not really a lot. It's just kind of going up because everything's going up.
yep.
I want to be in the first one, not the second one.
100%. And that's always been the case. But in today's world with cash equity, with indices, equity indices, it can never be more. And there's not a better time to be reminded of that because you can have huge days where all the indices are up, but I mean the Nasdaq may be up materially more or down materially more than the Russell, or the S&P. And so I'm just always looking to be in whatever's the strongest one. So it can go without me.
So
Maybe I
true.
didn't have it set up. I can be waiting for a pullback and
Yeah.
maybe I didn't get it. I don't mind to miss
Right.
something. I just don't
Right.
want to chase the wrong thing. So
Of course. Yeah, I say that all the time. I miss trades all the time, but I'm focused on the ones that I'm actually doing. You know what I
it's
mean? I always say
100%.
I got 37 trades 37 markets that I trade. So theoretically, every day there's 37 trade markets that are either going up or down, and I could be in, but that doesn't mean anything, right?
And
You
that's
focus
that's
on
the
the ones
beauty
that
of.
I'm in. That's what
Yep.
matters, right?
Yep. So it really is a filter
Interesting.
top down, like which asset classes have the opportunity set to really pay you, which of those products then have the setup and have somewhat of a view, and then is price action showing me something? Now we're in the game. So there's a lot of patience involved, but that's true with all trading.
All good trading,
Yeah, yeah, yeah. I mean, there's not,
not all
there were some
trading.
easy days back when you and I were together. I mean, the market was a lot less efficient, right? I mean, with algos and technology, the market can process information and reprice much faster and more efficiently. And the extent of the moves we get in today's world are pretty dynamic at times. But yeah, you can't. So it would be easy to overtrade in this world.
For sure. I see people do it every day. I mean, also, we got to remember, I always said that the thing about Gelber was, especially you guys, I wasn't doing this, but you guys, Gelber was one of the beta testers for electronic trading. So
Yep.
like you and lightning, right? You guys are like the first ones that had that shit on your desk. So I remember the news would, some news would come out, it didn't matter what, and you guys would be like, bam, you bought them electronic before any orders could ever get down to the pit. So like you were 15 S&P points in the money before you even freaking knew what happened, right?
Yeah, we had
So,
time to talk about it and still get them. And today, I hardly grab the mouse for any economic number, right? I don't have the speed for that. I mean, we have a few tricks and things we do, but I'm looking for material surprises in economic data points to trigger something that could be a bigger move, and also just market positioning. Then, if the market's positioned, short bonds, and I tend to think that they're wrong, and we were going to get a data point, supportive of that, then market positioning comes into it too.
how are you measuring market
So
positioning?
people ask me that a lot. I will say half of that is, I'm going to say, unfortunately, 25, 30 years of doing this.
Let's do a winning trade that has happened recently, that what you were seeing, why you executed it, how you got in, how you got out, etc.
Well, I already, just because from this week, but we were talking about the don't be short, but over the short term. But so we talked about how the tape was showing some weakness in the AI tech space. If you look at the SMH, the 3-day pattern, they're pretty consolidated, and you got a lot of negative sentiment. So you on Friday, you short through that prior day's low. It was hovering right there, and you get a quick spike down. The stops to prior day's high. You're looking for 1-to-1. You take something out, and then as long as it closes a winner, you keep it. Let's see, the before that, probably the best trades of last month was catching the yen down, and then catching. So we started the month, and you had the Japanese elections, right? You get a surprise move, you got a surprise response. The yen is consolidated. It's consolidated naturally because we're waiting for the outcome of the results. But you get Takachi wins the election. It's a surprise to the dovish side. The market opens down out of the range. Back to it's been consolidated. Sure, it's got a decent gap down, but you just got to get in. You put a piece on, and it continues down for like 5 to 6 days. And if you go look at the, like, say, half day chart intraday patterns within it, you get, there was a couple chances to do the 21 to 34% pullback in it, and you're continuing to lower your stop to 55% of the move, and next thing you know, you're making 3-to-1 on the trade. So
Yeah, that was a good
those
one.
are
That was a great one too. From I think in particular from what I understand about your process, because the way I read it was it was a flip in beliefs. People up to that point, to me, have been believing that Japan was going to be raising rates, right?
right.
And all of a sudden, this person got elected and came out and said, we're getting on the Trump train, and we're not raising rates. We're creating liquidity like everybody else. So like it was such a big flip in the thought process of the fundamental that it had such a good potential for a good move.
Yep. But both of those are, I mean, we can do more, but both of those are examples of, if you just
Right.
look at the charts into those events there, you've got a consolidation, and you'll naturally consolidate it into big events. But anything that's a surprise, the market's not ready for it. So you first you get some on, and then you can do the pullbacks within it. So
Got it. Thank you for that. Right. So when you mentioned news, so again, you want to be long this thing. The vol's been contracting. You're looking for a sort of a vol expansion to get on it. Is it this? So let's say you're looking to get long this thing. Some positive piece of news gets released. Again, you're looking to get long oil. It's kind of set up for you. Now we get an oil inventory report that's super bullish. The thing breaks out. You're buying that?
yes, yeah, I'd be buying that. Yeah. I mean, I'm
Gotcha.
not as sensitive to the inventory numbers weekly in crude.
I was just
There'd
giving
be
an
some other
example,
reasons
but
for my preconceived bias to be buying gold, but yes, I'd just going with it. And anything with momentum outside the 1 to 3 day high, if it's already set up in there, I'm going with it. So
what happens if you buy that news and then the market fails on it after you buy it? That you just cut out of it?
yeah, so I mean, usually the stop would be the prior day's low. So there's the key to survival is day one. My stops are a lot tighter than yours, but yeah, the key to survival is usually day one. Day two, it needs to be working further, or else the stop's going to raise up. And then the ideal scenario is then the market follows through, and you get kind of a pullback setup with it. And I don't use a whole lot of technicals at all, but I'm a big math guy, and the simplest, stupidest pullback metric is just to use 21 and 34% of the way back of any momentum move. To That should be the maximum pullbacks, and I'm not expecting it should ever get back more than 55% of it. So which makes sense. Gold or crude spikes a $1.50. I don't expect that it should pull back more than 40 to 60 cents. And and I've got my stop. I can start to raise my stop up to like 80 to 90 cents below there, and let it go. So the ideal scenario is, yes, I'm on it early, breaks out, it works, it follows through the next day. You get a pullback of 21 to 34%. I can add some more, and the whole stop raises up. If it reverses that day back through the prior day's lows, then I'm stopped out. But that can also be a tell. As long as you're sticking to a process, whatever process you have, even losing trades can tell you a lot about the market. And so, fast moves come from false moves, right? So a lot of times, if I'm getting stopped out on some trades over a 2 or 3 day period, a lot of them, there's probably something that is shifting within the market itself. And so I think that for younger traders, especially, the key to having a process that you stick to is you can learn as much about future market price action from winning trades as losing trades, as long as you're sticking to a solid process. Because if there is truly something shifting, either in your view, either in my opinions wrong, or some other cross asset relationship, it's going to inform you, because I'm going to start to get stopped out in multiple trades over a few days. Whereas if you're
Good
getting
message
follow
to the
through,
market, man. It's very,
it's
very,
you.
very important. This is what people
Yep.
don't want to listen to. One of the three things that I'm always talking about. I'm always talking about positioning, as you know. I'm always talking about sentiment, and I'm always talking about market action, right?
Yep.
And I think of all the three, as much as people see me as this big positioning guy, and that's true, but of all the three, I think the third one is by far the most important, just because it'll keep you out of trouble. You know what I mean? If you are long it for whatever reason, it broke out, it's bullish, blah blah blah, and it's failing, you know what I mean? Well, then it ain't working. The market is telling you, right? And
Yes.
this will, if nothing else, in my view, will at least keep you out of trouble. If you don't fight the market and you just take your loss, whatever, then at least you're not losing a lot of money, which is, as you know, so important, because you're going to lose money sometimes, and you don't want to lose a lot, because then you spend a lot of time just making it back.
Yep. And that's some of the younger guys where when you begin to overtrade or violate some of your process rules, you're not learning anything from a winner or a loser. I mean, this recent tech pullback, Oracle kind of kicked things off a while, several weeks ago, but you look at that chart, things just been going down for 2 weeks. So there's some message in price action, and it's not just in tech or wherever it is, but and that's basically what has kept me in the game this long. I mean, I love the game, and so yes, I trade a lot more than you do, but that means I'm close to the market. I'm basically a tape reader. I'm looking at the tape all the time, and it's just fascinating, whatever message it's given you on the day. And so my job is not just to go through the process to find new setups and trades, but what price action told us today. That's what makes it fun.
I love it. Um, so why don't we get into now? What are you thinking in general?
I mean, I think that so
Bubble, not bubble.
I don't think not bubble, because it's still isolated. Well, here's the thing. The top nine stocks in the S&P 500 are 40% of the index, right? And that is the highest weight, and those are also now the most volatile of the tech. So trading, when we talk about the market, we always talk about the world references the S&P 500, but come on, it's the S&P 9. I mean, Berkshire, I think, is number 10, but the top nine are big cap tech. They're also the most volatile. We've not had a period, in history. It's always these indices are always cap weighted, so it's always top heavy. But the S&P is essentially Nasdaq light, nowadays, and so it's a lot more momentum in it. And so, what do I think about the market? I mean, are those stocks rich? Of course. I mean, but the story behind them is pretty amazing. And there's a lot of uncertainty recently creeped in, obviously, with the OpenAI stuff, and who knows how a company with 20 million in revenues can have 1.4 trillion in commitments, but that's not that only time will tell. So those nine stocks, I mean, I'm just interested in short-term patterns on them, and not willing to make a call that they're out. But if you look at RSP, the equal weighted S&P, I mean, that's not in a bubble. And overall, I mean, the environment's pretty supportive for equities. I mean, we've never had a bear market when the Fed is easing and earnings are increasing strongly, and earnings are increasing strongly. So, is it rich? Has it been pretty goofy? And have nine stocks contributed to all the gains? Sure, but I don't think that's a reason to get all bearish here. I think we have
Looking like a true trader.
I think we're gonna, the K-shaped economy will continue. Like top 10% of the earners generate over half of the spending now, and so I don't. It's hard to see how that ends, right? It's a very pro-growth administration. So what really is, we're in this environment where it's so top heavy that that we have volatility, that's like spectacular for traders. But I don't think that you can say that the market as a whole is in a bubble. I mean, you get into next year, we're probably going to have a couple hundred billion in stimulus through in like April from that Build Back Better Act. That's out there.
New
Into the
Fed
end of the
chief
year.
coming in, that's going to be friendly.
What's that?
New Fed chief that's going to come in and be very friendly.
That's what I was going to say. So I think like the trade that I'm interested in through the end of the year is I think we'll get the Fed chair announcement by the end of the year, to be in place by May. But I think they'll tell us who that choice is, and who it is will matter. I mean, it's probably the most divided Fed that we've had, but the market's way looking ahead that we know the new Fed chair is in May. It's going to be they're going to be market friendly. Depends on who it is. I mean, if I tend to think it might be Reader, but that I think that's a trade that's coming, and that will set up a pretty discernible bias in the short end and in whether or not we steepen or flatten. Um, so I mean, I think that volatility and you get these recent downtrends, you get there's opportunity. I mean, Friday afternoon, as the semis and tech was getting drilled, it didn't take long for RSP, the equal weight, to come back and make a new high by like 10 a.m. on the day, even though down a little. And then once it does, it just keeps on going. It's super rare nowadays in this bull market that we have any actual distribution days. Where you get a red flag that, oh, there's some more to this, is if I looked up and all the major indices were down an equal percent relative to volatility, that's when
Right.
you know there's more to come. And it's so rare that you get that. So anytime that we're having one of the big down days or up days, I'm equally interested in how the other stuff is performing relative. And it's just a giant rotation game where the money flows into those top nine names and or the quantum or some other theme, and the other stocks take a hit, and then vice versa. So
Yeah, the next
I mean,
day
look
it
at
flipped the
Caterpillar.
other
We
way.
don't have
I watched
like
I always like to watch the Russell versus the Nasdaq type of thing, and it's just so silly. Like you try to get a read on it, but the truth is, today they, like you say, they all piled into this one and out of that one, and then the next day they all piled into this one and out of that one. Like
yeah.
there's almost no read there at all to me.
I mean, there's some occasional, I'll just do this blindly. I mean, the better the news for tech is on the day and we all open up, the Russell's going to go down. It's
Right.
essentially just a rotation game, and then the vice versa. So we're constantly watching those kind of tells in the market to see if things are any different. And I don't think last week showed me anything different, even though, a bit of a tech pullback. But I think they're still fine. I like China. I like China a lot. I mean, the longer term bar stuff that I have is more some upside calls, and because I don't really have tons of setups in there right now outside of like a EEM, the emerging market index has come back in a pretty orderly, calm pullback to the 20-day. But so I'll do that too if I do have a view, but I don't really have the pattern. I mean, I'm okay putting bar out in either a wider stop or some upside calls or call spreads, and then but it's also it's like a placeholder. I'm looking for one of my short term setups to really get me in.
Anything else other than equities? You got a view on fixed? You got a view on whatever
So
crude?
fix
You got a view
fix
on any of this stuff?
So fixed, I think, is going to come down to the new Fed chair, and the reality is, so like claims and inflation, I think will stay in check. I'm not really actually worried about inflation. It all comes down to unemployment, and if you unfortunately we haven't had any data, so for me this has been a boring month with the government closed, even though it's not sure how reliable all the data is. But the claims and unemployment rate, they're pretty stable. But if you think about the surge in youth and black unemployment since 2017 to 2018, I mean, it's pretty disturbing. So the net of this is that it all comes down to unemployment, and I tend to think that will be weakening, and so I think you'll see with the new Fed front end loading. So I like fixed income. I like 5 years. I like 10 years. I'm less sure about the bond for a lot of reasons that are somewhat obvious, and whether the curve steepens or flattens based on the Fed choice. But I like fives. I like tens. A lot. And I'm constantly looking for setups to buy that. But I think that a lot of that, I'm excited to see what the next Fed chair is and follow the data.
I don't really know if I should get into this, but I'm going to because it's what's been on my mind the most, in
Yep.
particular this week, because of some situations that happened with some people that I know personally. It really brought it to the forefront. We don't live in the world of, we've been somewhat fortunate. You can call it fortunate, you can call it that we worked our freaking asses off, call it whatever you want. But we don't live in a world where, I'm worried about, am I going to be able to put food on the table next month, right?
Yep.
Um, but there are a lot of people that do live in that world. And that number is getting bigger and bigger and bigger, it seems, right? The
Yep.
wealth gap, in other words, is really going crazy here. And to me, I look at it almost like those charts you see about compound interest, right? Where they get to a certain point and they just go straight up. I feel like it's the same thing. Rich get richer because they're getting richer. And as they get more rich, they get more rich. And the compound interest thing is just exploding.
Yep.
Um, and while they're starving and while they are having trouble buying whatever health insurance, not to get too political about this, and while they are having trouble, and I understand there have to be poor in a society. Not everybody can be rich. I get that. But, I know people who work, teacher, husband's a cop, right? And they can't, they're struggling, man. Like horribly struggling. A teacher and a cop who have three kids.
Yep.
They're lucky to make it to the end of the month. These aren't lazy people. Okay, they're not hedge fund managers. You know what I mean? But not everyone's a hedge fund manager, you know? Uh, do you worry at all about any of this? That eventually this has to, and eventually it has to, and that could mean 150 years from now. So it means nothing for us. Okay. But do you think that that's going to have any effect? It's very hard. I have been bullish the whole way. Okay. Because of the money flow stuff that I look at, right? People have been short. I'm convinced that there ain't a person in the world that can tell me that they are overweight equities since April. All right. There are
Right.
people making money in their stock accounts. Okay. But their stock accounts are probably 20% of their net worth, right? I don't think there's a person in the world. And so based on that, I've been bullish. Well, based on that and the fact that the market keeps going up, I've been bullish. But and there's nothing to stop that, and I get that. But plus the Fed, look, they're cutting rates into this whole thing. But do you think at some point there's a problem here?
So, and that gets to, I mentioned early in the podcast, the K-shaped economy, and I don't see that ending. The top 10% of earners, probably contribute 70% of consumption, and so that's massive. And then the bottom leg, that's 45-degree angle down in the K, as you mentioned, the lower income, I don't see that ending. I mean, I look there, I would assume there's a living wage at some point years out in the future of this country. It's just because the vision for the K economy to end seems low. And the policies of the administration and the Fed has always been to essentially to be as easy as possible, and so you continue to increase the capital wealth of the top, and that will continue to get recycled into the economy. The it probably gets much worse than what we're seeing right now in the lower income, because the job market for new graduates, and the future of the impact of AI, is certainly worrisome. But so no, I don't think it gets better. I think it continues to exaggerate further.
Yeah, I
So
mean, I'm
yeah,
not so worried. I mean, or at least for our perspective here, I don't want to sound cold.
no,
I am worried for people, but I'm not so worried about the philosophical, political. I'm just talking market wise, and I guess as I listen to you and as I think about this, which is why I wanted to bring it up, it's actually bullish because if more money is going into the hands of the rich, then more money is finding its way to the market. The poor people ain't putting money in the stock market. The rich
that's
people are
exactly
putting
right.
money into the stock market, right? So more
Yep.
money is getting in their hands, and that's just more money going into the markets.
And I think that's the main point. What I was about to say too is yes, I do worry about that stuff. But look, we're on this as a topic of trading, and the job is to make money,
Right.
not to be sympathetic to one side or another,
No,
and
that's right.
not to be right. And back to we talk about the market as the S&P 500. Well, the S&P 500 is market cap weighted. It will always be. So it's constantly adjusting to the top 500 companies, and the ones that are doing the best are increasing their weight. It by default. It's the most moronic thing to bet against to bet against something structured that way over the long term.
Totally
and uh,
agree. No,
and
the S&P essentially rides its winners and cuts its losers.
yeah, it
And the
sure,
Russell does the exact opposite,
right, right,
right? If you're in Russell and you grow, then you get kicked out of the Russell. So they're cutting
right,
the winners and riding the losers.
exactly. So it by default, it's just something you have to be long for yourself. Can we have a multi-year bear market or something? Of course of course we have. But back to what I said earlier, I mean, the Fed's easing earnings for those top weights in the S&P 500 are increasing. So that the backdrop of that has always been supportive of equity. So I'm sure you were a buyer when we got the big dip in March, April, and so it's bigger position trades. You're just looking for market corrections. I think unless there were material changes in those fundamental backdrops that we just discussed, they're opportunities. So,
I mean, I always go back now that I'm 58 years old, and I've been doing this for so long, and I've managed money here, there, and everywhere, and if you add up the amount of money I've managed over my life, it's a pretty big number. If I did nothing but take that money and frickin' buy Qs and collect 2 and 20, 0 and 20 off of that, I'd be a frickin' billionaire. I mean, it's all easy in retrospect, but I almost feel like every old Wall Street guy comes to this conclusion eventually. Like, shit, I should have just been dollar cost averaging into technology.
100%, sir. 100%. I think that
I
I
wasted a lot of frickin' hours worrying about the next frickin', 50 S&P points. When really, if I had just done that my entire life, I'd be a lot richer than I am.
take a look at the annual chart of the S&P 500 for the past 100 years. It doesn't look like something that's going to end. So, but that I'm a short-term trader, so there are all
Right,
kinds
it's
of
irrelevant,
opportunities,
right?
and I think that like the opportunity for us for trading is only going to increase. Sure, it's more difficult, AI, and the ability for the market to digest information faster, but as I used to always think, as the higher the S&P goes, they haven't changed the point value of the S&P of the E-mini, right? And now, 100 basis point move is 65 points in there. So
Yeah,
there's
it's pretty big, but they got
a
the
lot more
micros
price
now
action
for
to
people.
trade than there was
They got the
when,
micros now for people that can't deal with
yeah,
that. They're like
yeah,
1/10 or something, those micros. So,
yeah, I'm not going
but,
down to that level yet.
no, I know, but I'm saying for people that can't, it's a big move, man.
Yeah,
65 points at
yep.
$50 a point, for a retail trader, that we're sitting here preaching, you can't lose a lot of money on one trade. You have to be disciplined, blah, blah, blah. Well, if you got $1 million in the account, it's one thing, but if you got 50 grand or even 25 grand in the account, then that's a big move, right? So
Here's my advice for
the
anybody who
micros can
has
help with that.
my advice for someone who has a bearish market view, more than my like 2 to 5 day or 10 day time frame, is you only short this booze long term if you don't need the money. So uh,
I love it. I
and
love it.
in our world, look, volatility that rises and equities that get forced to liquidate, it just increases cross asset opportunity. So there's as much or more opportunity for me to make in currency crosses or fixed income dislocations. And at every one of these drops in the S&P this year of any 3 to 5 day magnitude, you've not had any cross asset correlation pickup. You don't have any material moves in Aussie yen. You don't have any material moves in flight to safety and fixed income. It there's very little cross asset correlation. So each of these, I'm always looking at everything else. For is there something bigger happening? There are a lot of vol control funds now. So many things are tied to what's our vol. And so as by default, as we go lower, the arb vol picks up and portfolios have to liquidate. So you can get a lot faster short-term moves down, probably like we saw Friday, that once that deleveraging is done, there's unless you're seeing the real pickup in either corporate credit spreads or flight to safety or currency crosses against the carry trades, there's probably not a lot behind it. The selling once the deleveraging's done.
It's funny because I was looking this morning. I don't have it in front of me at this desk. It's at my other desk, but some of these stocks, I mean, CrowdStrike, Oklo, some of the old sort of favorite stocks in this. I mean, a lot of these things are down 35, 45, 55% from the highs this year.
Yeah, so one cool part about being now affiliated with an equity trading firm, Kirshner in Austin. I mean, they're they're true momentum and they're playing everything. I mean, the cash equities that I'm interested in are more the S&P 500 names. There's a
Right.
little too much. It's hard for me to put a real fundamental story on Oklos and the nuclear names and the CrowdStrike. Some of those. I mean, I get it, but there's just a lot of price action to. But there's so much opportunity when I don't have any setups or anything operating inside the future space, there's always a sector that's moving, and I think that's been kind of a game changer to have another outlet so that you're back to trade what's moving, not what's being moved around. So I think there are fewer. I think from the time I've known you, like the number of equity short-term S&P trades that I do has continued to drop, and it's just a function of that the S&P is a Nasdaq light, because it's so top heavy. So those patterns are just being derived by what's happening inside the tech space. So go to
Sure.
the sectors that are moving the most.
I love that phrase. Trade what's moving, not what's being moved around.
Yep.
Jason Rowan. All right, well, cool, Rowan. I love it, man. Anything else you can tell us? How do we make money? Give us one last tip. You gave us a lot of good ones, but
Uh, I don't know. I think China's up into the end of the year. I think. For Monday, I'm excited for the gold to possibly have a move, that triple NR7. I think that
You're
the
bullish
stocks are
gold, I
kind
think.
of. I'm still bullish. Yeah, but so the beauty is, it could, if it starts down and drops $100, I won't get any. I'm
No,
going
of
with it
course.
through Friday's high on any momentum. Um, currencies I think are just a stay away trade for now, and then I think that there's a lot of money in long fives and tens. I just, you really need the catalyst, and I'm assuming the Fed chair announcement, which we'll get by the end of the year, will be the start of that. I think once the government opens, the data is going to show a pretty good downturn in unemployment. I'm not worried about inflation, and then don't short the spoos long term unless you don't need the money.
I mean, I think the gold thing is like, me, like I'm always trying to fade consensus. That's my whole thing, right? But
Yeah,
A, I don't know if that is consensus, and B, it just seems very, very hard to short something like gold when the Fed is just flooding the world with, and the central banks around the world are flooding the world with liquidity, and they're just going to continue to do that. There's no
yeah,
stop. In my view, there's no stopping that, right?
yeah.
Like there
And
is no stopping it because if
now
you
we have
stop it, everything's going to zero. So there is no stopping that.
and really it's been, the U.S. the driver of the printing money, but now in the Trump era, we actually have Germany picking up spending. So this is a
China, Japan
unique
now even
environment
too.
that if you just go around the horn, who's expanding balance sheets? Um, it's the train seems still, you know is still strong, and that's a good backdrop for gold.
Yeah, I mean it's one thing. It's one thing to try and fade people, but trying to fade City Hall to me is a whole nother thing. You know what I mean?
Yep.
They will, I believe they will run out of money one day, but that one day could be 100 years from now. Okay, so like trying to fade City Hall right now just seems like a horrible, horrible thing. Anyway, my thoughts. Jay, I appreciate your time, man.
Hey,
You're the
This is
man.
great. Good.
I hope you people are listening, and I hope you people are taking notes because it's clear that what he's saying is makes a lot of sense, and it's also I can tell you because I've known him for 25 years. This is a very successful trader right here. So you may not, like the expression on his face. You
Because
may
I'm
not like
old.
you may not like his golf shirt. You may not like the fact that he's talking to a jerk like me. But if you want to listen to people that are very successful at doing this, here is one. So I would listen. I would go back and I would listen again and I would take notes because Jade knows what he's talking about as measured by the only thing that matters, which is P&L.
Great talking to you, man. Good old friend, and nice to catch up again.
All right, my brother. We'll talk soon.
Thank you.